Hello, everyone, and you're all very welcome to this FRS 102 webinar. I'm Eamon Dillon, a partner in our accounting advisory team, and I'm joined here today by three other team members, Rob, Kelly, and Saad, and together we'll be bringing you through the content of the webinar today. Just to provide some context before we get into the detail of the session, this is the biggest change to FRS 102 since the standard was introduced over 10 years ago. And the amendments are all about aligning FRS 102 with IFRS. So the revenue and lease requirements from IFRS have essentially been dropped into FRS 102, along with some other changes. And that makes FRS 102 significantly more complex to apply. And it also really closes the gap between applying IFRS and FRS 102. When the amendments were published about a year and a half ago, it felt like the effective date of 1 January 2026 was very far away. So for a lot of people, they didn't really put too much focus on the changes. But now 1 January 2026 is right around the corner. So it's a good time to get focused and engaged on the changes to FRS 102 and make sure that you've got a good plan in place for your entity to make sure that you can implement the changes nice and smoothly. And that's why we're here today with the webinar to help you. Just to give you an overview of the session, the key changes are in the area of revenue and leases. So Rob is going to talk us through the revenue requirements and Kelly will talk us through leases. The revenue change in a nutshell is that a new 5-step model has been introduced into FRS 102 for determining how to recognize revenue. It's essentially the same model as we have under IFRS, but for FRS 102 preparers, that means that there's now a much more structured approach for how you recognize revenue. And it's also a lot more technical than it used to be under FRS 102. For leases, everyone has probably heard that the main change there is that operating leases are coming on the balance sheet. So there'll be a right of use or a lease asset on the balance sheet. There'll be a corresponding lease liability. Under FRS 102, operating leases are off balance sheet. They're just disclosed as a commitment within the notes. But applying the requirements that we now have under FRS 102 is not as straightforward as taking that commitment disclosure and putting that on the balance sheet as an asset or a liability. There's more to it than that, and Kelly is going to walk us through those requirements. While revenue and leases have been the areas that have got the headlines under FRS 102 for these changes, there are some other changes, and Saad is going to walk us through those. Just some quick housekeeping items. First of all, for the webinar today, we'll take about an hour and 15 minutes to walk through the requirements. There is a facility for Q&A there as well. We'd love to hear your questions as we go along through. So if there are some questions, pop them into the Q&A, and we've left some time at the end of the session to work through whatever we can today, and ones that we can't, we'll follow up individually with you in any case. In terms of the session, we've really tried to make it as practical as possible. So we've lots of illustrative examples as we go through the session, rather than using lots of theory to teach the points. There is some audience participation as part of that. We have polling questions as we go through. So when you see those polling questions, please pop through an answer. Don't worry, they're anonymous. Nobody will know whether you got the answers right or wrong other than yourself. But great for people to take part in that. Finally, just to note, actually, this is a live session. So if you do lose connection at any point, log out, log back in again. Hopefully we'll still be here. And worst case scenario, we'll drop a recording of today's session on the website soon. So with that, I'm going to hand over to Rob, who'll bring us through the revenue requirements. So Rob, over to you.
Thanks, Eamon. So the FRS 102 amendments introduces a comprehensive 5-step model for revenue recognition. And as you've noted, it largely aligns Section 23 of FRS 102 with IFRS 15, revenue from contracts with customers. And I suppose when I kind of stand back from it, I think the overall objective here of the new revenue standard is to provide clearer guidance about when to recognize revenue and at what amount. And in some areas, there are significant changes to the current accounting treatment. So all entities will need to consider the requirements in detail to facilitate careful planning, both for reporting and for wider commercial purposes. So revenue now will be recognized when or as control over the goods or services is transferred to the customer. In contrast, previously would recognize revenue when the risks and rewards of ownership would transfer. So the model introduces 5 steps. So the first step is to identify the contract with the customer. The second step is to identify the performance obligations in the contract. The third step is to determine the transaction price. The fourth step is to allocate that transaction price to the performance obligations in the contract. And the fifth step then is to recognize revenue when or as the entity satisfies a performance obligation. So the core principle is to align revenue recognition with the transfer of control of goods or services to customers, which may either be over time or at a specific point in time. And I suppose this also aligns revenue recognition then with the contractual terms in relation to the enforceable rights and obligation of the customer and the supplier. And I suppose the 5-step model aims to address some of the challenges that currently exist in accounting for bundled goods and services, whereby it introduces this concept of allocating the consideration from the customer to the separate and distinct performance obligations, which represent the promised goods or services within that contract. And the amendments also provide guidance on several topics, such as combining 2 or more contracts which are entered into at or near the same time with the same customers, guidance around contract modifications, and a number of practical expedients. And what I tried to get across today is it's important to note that this 5-step revenue recognition model could alter the timing of revenue recognition for people here on this call, especially if you have complex contracts with bundled goods and variable consideration. So let's start with the first step, which is identifying the contract with the customer. And under the new amendments, judgment will now have to be exercised in determining and identifying the scope of the contract with the customer for revenue recognition purposes. And in some cases, this will be relatively straightforward. However, it's important to be aware there could be increased complexity where you enter into multiple contracts with a customer at or around the same time, or if you enter into an agreement to provide multiple goods or services. So some of the things that an entity will have to consider is, well, firstly, if the contract has been approved and if both parties are committed to performing their respective obligations, you'll have to think about if each party's rights can be identified. You'll have to think about if the payment terms can be identified, if the contract has commercial substance, and you'll also have to consider whether it's probable that the consideration will be collected. And in doing so, you'll have to consider the customer's ability and their intention to pay the amount when due. The second step then is around identifying the performance obligations in the contract. And a performance obligation, well, what is that, right? So it's a promise to transfer to the customer either a good or service that is distinct, or a series of distinct goods or services that are substantially the same and at the same pattern of transfer. So the next question people have is, well, what do you mean by distinct, right? So goods or services are distinct if both of the following criteria are satisfied. It's really key that both of them are satisfied. So the first criteria is that the customer can benefit from the good or service either on its own or together with other resources that are readily available to the customer. Typically readily available would mean that you could get the kind of goods or services from another supplier. It might be something you have readily on hand. And the second criteria is that the promise is separately identifiable from other promises in the contract. So the kind of key questions here are, do the individual promises within that contract modify one another? Are they significantly interrelated or inputs into a single combined output? And what I'd like to highlight here is that performance obligations are not necessarily limited to the goods or services explicitly stated in the contract. This is because a contract with a customer may also include promises that may be implied by an entity's customary business practices, published policies, or specific statements if the promises create a valid expectation. So we're going to look at an illustrative example now, and we're going to kind of highlight where the judgment kind of comes into it in terms of applying this analysis. So in this example, an entity enters into a contract to design and build a hospital for a customer. The entity is responsible for the overall management of the project and identifies various promised goods and services, including engineering, site clearance, foundation, procurement, construction of the structure, piping and wiring, installation of equipment, and finishing. And in applying the criteria, the entity identifies that many of those goods or services would meet criterion 1, right? This is because the customer could benefit from the goods and services on their own. Kind of each construction material is sold separately by numerous suppliers, or could be resold for more than scrap value by the customer, or together with other readily available resources such as additional materials or the services of another contractor. So criterion 1 likely to be recognized. However, the entity determines that criterion 2 is not met because it provides a significant service of integrating those individual goods or services to produce the output, which is the hospital for which the customer has contracted. So as a result, because criterion 2 is not met, the entity would account for the contract as a single performance obligation. So that's where the judgment is. We're going to look at another example now, and we're going to launch it in a poll so we can give everyone a chance to have a go at the answer. So in this example, an entity enters into a contract to provide a software license to install the software and provide software updates and technical support to the customer. The software can work without the updates and technical support, and the contract specifies that the software will be installed by the company. However, despite the contractual limitations, it's theoretically possible that the software could be installed by a third party. How many performance obligations do we think would exist in this scenario? Do we think it's A1, B2, C3, or D4? And we'll give people a few seconds to have a go at answering this. Okay, we'll just close the poll there. So we have a good mix of answers here. So we have 14.2% went for 1, 30% went for 2, 35% went for 3, and 19% went for 4. So well done to the 19% who went for 4. That is what we have gone for as the most appropriate answer here. So why have we gone for 4? Well, firstly, if we think about criterion 1, the goods and services being provided are distinct as they can be sold separately and the customer can benefit from them individually. As noted in the question, the software remains functional without the updates and technical support, and the installation is deemed to be a separate performance obligation since the customer can theoretically obtain the services from other entities as well and is not required to obtain the installation services from the entity. Now, the key piece here is that for the purposes of determining whether or not it's a separate performance obligation, you actually ignore contractual restrictions. The key piece is whether, in theory, it's actually possible that another entity could perform those installation services. Because, in theory, another entity could perform the installation services, that doesn't significantly affect the customer's ability to be able to use and benefit from the software license. As noted, the updates don't affect the software's ability to perform, and the entity also considers then that none of the other services significantly modify or customize one another, nor is it producing a combined output. Therefore, we would conclude that they're not highly interdependent or highly interrelated because the entity will be able to fulfill its promise to transfer the software independently from its promise to provide those subsequent services. So we now move on to step 3, which is determining the transaction price. And for this step, what you really need to ask yourself is, well, what do I expect to get paid? And sometimes identifying the transaction price in the contract will be relatively straightforward. However, it is important to be aware of and to ascertain complex considerations which may be included in your contract. So things to be aware of are variable considerations. So this is potential adjustments to the transaction price for things like discounts, bonuses, rebates, refunds, credits, penalties, etc. They're uncertain at the time of the contract. You also have to be conscious of the existence of financing components, so kind of the existence of contractual payment terms that reflect the time value of money. You have to think about non-cash consideration, which, as the name suggests, is consideration in kind. For example, property, plant, and equipment, or shares, or in rare cases now, barter transactions. And you also have to be conscious of consideration payable to a customer. So this would be any amount that the entity expects to pay to the customer, which will result in a decrease in revenue. And it's important to note here that if the payment is made in exchange for a distinct good or service that the customer provides to us on an arm's length basis, then that is not a reduction in revenue. It's treated as a separate purchase, just like any other supplier expense. So in the next couple of slides, we're going to look at some illustrative examples, looking at some of these complexities in practice, focusing particularly on variable consideration and the impact that has on the transaction price. And in the first place, when we talk about variable consideration, an entity needs to be able to estimate that. And the standard provides that that can be estimated under one of two methods, with the method chosen being the one that best predicts the amount of consideration that the entity will be entitled to. So the two methods are, firstly, the expected value method, which is effectively the sum of the probability weighted amounts in a range of possible consideration outcomes. And the second then is the most likely amount, which, as the name suggests, is the single most likely amount in a range of possible consideration outcomes. Now, typically, we'd expect that that method would only really be applied to contracts where there's two possible outcomes. So it's binary in a way. So, for example, either a performance bonus is achieved or it's not. And once then the variable consideration is estimated, the entity will include in the transaction price the amount of that variable consideration estimated only to the extent that it's highly probable that the entity will be entitled to the cumulative amount of revenue recognized when the uncertainty associated with the variable consideration is subsequently resolved. And at the end of each reporting period, then, an entity will need to update the estimate of variable consideration included in the transaction price to reflect any relevant changes in circumstances. So let's look at an illustrative example here and put the theory into practice. So in this example, we have Company A provides construction services, and a customer engages Company A for the construction of an office building on land owned by the customer. They agree on a fixed consideration of €500,000. And for this example, I want you to assume that there is no need for unwinding of discounting. So there's no significant financing component. And if we take the first scenario, the customer has also stated that they will provide a 10% bonus to the company if the building is completed in 2 years. If it takes 25 months, the bonus will be 5%. And if it is completed within 27 months, only the contract price will be paid. So the company now is going to use the expected value method to derive the variable consideration to determine the transaction price. So the company estimates then that there's a 50% chance that the building will be completed within 25 months, a 10% chance that it will be completed in 2 years, and a 40% chance it will be completed in 27 months. And that leads to the expected value calculations then that we've included in the below table. So taking the probability times by the bonus amount giving us a weighted average expected value of 17,500. So in this scenario, the transaction price using the expected value method will be the 500,000 of fixed consideration plus the expected value of the bonus of 17,500 euros, giving us a transaction price total of 517,500 euros. If we take another example in this space, and let's slightly tweak the fact pattern and say the consideration stipulated in the contract is 500,000 euros, but instead of there being a bonus for on-time completion, the contract states that if the building does not meet an A3B or rating, there will be a penalty imposed of 30,000 euros. And based on historic experience with similar projects, there's a 65% chance that the building will not meet that standard. So in this scenario, the fixed consideration is not going to be your 500,000 euros identified in the contract. Rather, as per the new guidance, your fixed consideration in the contract is only 470,000 euros. The reason for this is that the penalty which can be imposed under the contract creates variability in the consideration that will be received. Now, in this scenario, it could be considered appropriate for the company to use the most likely amount method to estimate the variable consideration to include the transaction price. This is because there are only two possible outcomes. Either the building will meet the standards or it won't. And if we use the single most likely amount method, our transaction price in the contract day one will be 470,000 euros. And the key reason for this is that there's a 65% chance that the building will not meet the A3B or rating, and therefore it is not highly probable that the entity will be entitled to that additional 30,000 euros of consideration. Now, as the contract progresses at the end of each reporting period, the entity then will have to update that estimate of variable consideration transaction price to reflect any relevant changes in circumstances. So the kind of key question you're asking here is, has the probability of the building achieving the A3B or rating improved? And to the extent that that prediction of variable consideration changes at the end of each reporting period, you're making that adjustment then prospectively. So we now move on to step 4, which is allocating the transaction price to the various performance obligations in the contract. And in the first instance, to do this, you will need to determine the standalone selling prices at contract inception of each distinct good or service underlying each performance obligation. And the standalone selling price is the price at which an entity would sell that promised good or service separately to a customer. Now, if those standalone selling prices are not available, well, then the standard provides you with three different methods that you can apply instead. So the first one is an expected cost plus margin approach. And this is effectively where you determine the price of each performance obligation based on the cost you incur on performing that obligation and your usual markup on those goods and services. The second one then is an adjusted market assessment approach, which effectively requires you to compare the market prices of similar performance obligations provided by different companies and adjust them then according to your company's costs and margins. And then finally, we have the residual approach. And you can use this approach when the standalone selling price for a certain performance obligation can't be determined. So you allocate all of the remaining transaction price to that performance obligation after deducting the rest of the performance obligations in the contract standalone selling price from the contract price. Hence, it's the residual approach, it's the amount left over. So let's look at that through an illustrative example lens. And in this example, a company sells gaming computer components. And we're going to assume here a gaming computer would include a graphic card, a CPU, a motherboard, and a VRAM. And the company sells these items separately at their own respective prices or as a package for €1,000 per gaming computer. And The company can sell each component at their standalone selling prices, so those are available, and they're listed in the below table. So the sum of the standalone selling prices is 1,100, but the package price under the contract is 1,000 euros. And to simplify things further in this example, we will assume that the assembly of the computer and the sale of the computer are separate performance obligations, and the company has an enforceable right to payment for our assembly services. So we now allocate the contract price, so the 1,000 euros, to each of the performance obligations based on their standalone selling prices. So what effectively does this mean? So it means that upon completion of the computer assembly, we'll recognize revenue of 45 euros in accordance with the contract terms, as this reflects the allocated transaction price for the assembly service, which otherwise would have been valued at 50 euros on a standalone basis. The remaining 955 euros then will be recognized when control of the completed computer transfers to the customer, consistent with the performance obligation related to the delivery of the final product. We now move on to the final step in the new model, which is step 5, where we recognize revenue when or as the entity satisfies a performance obligation. And a performance obligation is considered satisfied when control of the good is transferred or the service is delivered to the customer. And I suppose entities need to take into account certain indicators then in determining whether or not control is transferred. And these factors include, but aren't limited to, the entity now has the present right for payment, the customer has legal title to the asset, physical possession of the asset has now been transferred to the customer has the risks and rewards of ownership of the asset, and the customer has accepted the asset. And when we look at performance obligations, we break them down into two categories, ones that are satisfied at a point in time and ones that are satisfied over time. And it's crucially important to distinguish between the two bases. And the new standard does provide criteria for determining if revenue should be recognized either over time or at a point in time. And an entity recognizes revenue over time if one or more of the following criteria are met. 1, the customer simultaneously resumes and consumes the benefit. 2, the entity's performance creates or enhances an asset that the customer controls as that asset is created or enhanced. 3, the entity's performance does not create an asset with an alternative use, and the entity has an enforceable right to payment for performance completed to date. If none of those 3 criteria are met, the entity will recognize revenue at a point in time. And this will be when the customer obtains control of the good or service and the entity is deemed to have satisfied the performance obligation. So we're going to look at another couple of polling examples here. So in this example, an entity enters into a contract to provide a certain quantity of goods to a customer over the year. The entity provides the goods at 300 euros per unit, and the total agreed quantity of goods over the year is up to 12,000 units. And the total consideration, therefore, in the contract is estimated to be 3.6 million euros. How do we think the entity should recognize its revenue? Option A, at a point in time when the goods are delivered based on the purchase order quantities. Option B, spread the 3.6 million euros evenly over the 12-month period, so over time recognition. Or option C, it depends. So we'll give people a couple of seconds now to have a go at that one. Okay, we'll close the poll there. So we have the majority of people have gone for at a point in time, so 58.8%. 12% of people went for overtime and 28% went for it depends. So congratulations to everyone who went for option A for point in time revenue recognition. We've gone for the same because this is when the customer obtains control of the individual good that's been provided. We look at another polling example now. And in this example, an entity enters into a 12-month contract with a customer for providing consulting services. Under the contract, the customer will receive professional opinions on matters requested by the customer during the term of the contract. And the contract price is agreed at €30,000 per annum. Additionally, there will be a specific fee for each opinion provided as well. And the entity estimates that it will provide 15 opinions during the contract term. And in this example, I want you to assume that the standalone selling prices for the performance obligations are the same as if they were outside of this contract. So how do we think the entity should recognize its revenue? Option A, recognize it evenly over the 12-month period, so fully over time. Option B, recognize it at individual points in time. Option C, a mixed approach, so recognize contract price over time and a specific fee at a point in time upon receipt of opinion, or option D, it depends. So we'll give people a couple of seconds with this one. Okay, we've got a lot of responses there, so we'll close the poll. So the vast majority of people have gone for option C, which is correct, the 87.9%. So well done, everyone, on that one. So what's the reason for this? We have two performance obligations here. One we would consider a stand-ready obligation, which is to provide opinions to the customer as requested throughout the 12-month period. This stand-ready obligation is satisfied over time by being available to produce opinions as and when requested by customer. And the specific fee per opinion provided will be recognized at the point in time the customer receives the opinion, as this is when the customer obtains control of the good provided. Finally, on revenue, we'll finish up by touching on some of the key differences between FRS 102 and IFRS. This is not an exhaustive list, but it's just a couple of the simplifications we wanted to highlight to you today. So the first is in relation to the cost to obtain a contract. So under IFRS 15, you capitalize those costs if the entity expects to recover them. So there's no account policy choice there, whereas a policy choice exists under 102 as to whether or not you capitalize or you expense. Again, for significant financing components under IFRS 15, adjusting for the time value of money for payments received in advance is not optional. There is optionality there under FRS 102. And in terms then of transitional provisions, IFRS 15 is retrospective application. Under FRS 102, we have a choice. We have retrospective or the modified retrospective approach, where we've no restatement of comparatives, and the adjustment is to equity retained earnings on the date of initial application. And with that, I'll finish up the revenue section, and I'll hand over to Kelly to bring you through some of the key changes for lease accounting. Over to you, Kelly.
Thanks, Rob. So in this section, we'll take a deeper dive into the new accounting requirements for leases. We're all very familiar with the accounting treatment under the current version of the standard, whereby lessees are required to classify their lease as either operating or finance in nature, depending on whether that lease transfers substantially all the risks and rewards of ownership from the lessor to the lessee. At the moment, operating leases are off balance sheet, with lessees disclosing their operating lease commitments by way of a note to the financial statements only. Finance leases, in contrast, are on balance sheet with the recognition of a lease liability and associated leased asset. Under the new requirements, the accounting treatment under FRS 102 will broadly align with IFRS 16, thus eliminating the distinction between finance and operating leases for lessees. Under the new requirements, lessees will be required to recognise a right-of-use asset and lease liability on balance sheet for all assets, taking account of any practical expedients or exemptions that might be available by way of short-term leases or leases for underlying assets of a low value. In terms of subsequent measurement, the right-of-use asset will be depreciated over the shorter of the lease term and the useful life of the underlying asset, whilst the lease liability will be amortised using an effective interest rate method, which will effectively front-load the interest expense, thus reflecting the financing nature of these transactions. It's important not to underestimate the complexity associated with this new model. Consideration will have to be given to a number of factors, including but not limited to whether or not a particular contract meets the definition of a lease and how to calculate an appropriate discount rate. The changes will also impact the calculation of EBITDA, other financial ratios and key performance metrics, which will be of interest to a wide range of stakeholders. So if we move on now to look at the recognition of lease liabilities and right-of-use assets, for ease, we can break the process down into 3 steps. The first step is to identify the contract, in the context of which it's important to be able to distinguish between a regular contract and a lease contract, bearing in mind the accounting principle of substance over legal form. So for accounting purposes, a lease contract should convey the right to control the use of an identified asset for a period of time in exchange for consideration. Step 2 is to identify the lease term. The lease term is the non-cancellable period of lease plus any expected extension period. And finally, step 3 is to recognise the lease liability and associated right-of-use asset. So let's take a look at step 1 in a little bit more detail. So a lease contract for accounting purposes, as mentioned previously, should convey the right to control the use of an identified asset for a period of time in exchange for consideration. To assess the right to control an identified asset over a period of time, an entity will have to determine whether, throughout that period, the customer has the right to obtain substantially all of the economic benefits from use of the asset and the right to direct the use of the asset. And what do we mean by the right to direct use? So the customer has the right to direct how and for what purpose the asset is used throughout the period of use in a manner that affects the economic benefits derived from its use, or alternatively, the relevant decisions about how and for what purpose the asset is used are predetermined, and the customer has the right to operate the asset throughout the period without the supplier having the right to change those decisions or instructions, or the customer designed the asset in such a way that predetermines how and for what purpose the asset will be used throughout the period. If we move on then to look at an identified asset is an asset which is specified in the contract and the supplier doesn't have the ability to substitute. This means that the asset must be clearly specified or implicit in the lease contract, for example, a particular vehicle, building, or item of machinery. The asset must be physically distinct and not just a portion of a larger asset unless that portion is clearly separable. And the lessor mustn't have substantive substitution rights where they can obtain economic benefits from that substitution, so the lessee must have control over the use of the specified asset throughout the lease term. And finally, in terms of consideration, so consideration is the total amount payable by the lessee over the lease term, including fixed and certain variable payments in exchange for use of the identified asset. This can be complicated if we come across certain types of variable payment, residual value guarantees, purchase options, or other penalties. In terms of variable consideration, in the context of a lease, variable consideration refers to those payments that are not fixed, but rather fluctuate based on certain factors. These typically include lease payments linked to an index or rate, such as CPI or LIBOR. And it's important to note that it's only those variable payments linked to an underlying index or rate that are included in the initial measurement of a lease liability to the extent that they're predictable and can be estimated reliably. Other forms of variable consideration or variable lease payments, for example, those based on performance or usage, are excluded from the initial calculation of the lease liability and recognised in profit and loss as they're incurred. So if we move on now to have a look at a few examples of what this means in practice. So let's take scenario 1. So here, a customer and a freight carrier form a contract where the supplier will provide the customer with the use of 10 rail cars of a particular type over 5 years. The rail cars are specified in the contract, but under the ownership of the supplier. However, the customer defines when, where, and which goods to transport with the cars, with some limitations. The customer may also use the cars for other purposes, and if the car is to be serviced, the supplier will provide replacement cars. The supplier can't retrieve the cars before the end of 5 years, and the contract also requires the supplier to provide an engine and a driver when requested by the customer. Engines are held at supplier premises. The supplier can attach other cars to the engine, and the engines are not specified within the contract. So based on this fact pattern, do people think option A, both the rail cars and engines are under lease? Option B, neither the rail cars nor engines are under lease? Option C, only the rail cars are subject to lease? Or option D, only engines are subject to lease? We'll give everyone a few minutes just to respond. Okay, so we'll maybe close the poll there, and we can see that the vast majority of people have gone with option C. Only rail cars are part of the lease contract. And the answer here is option 3. And this is because the customer obtains substantially all the benefits from the cars over the 5 years, including those periods when the cars are not being used to transport goods. In addition, the engines in this contract are not specifically identified assets, and hence they don't form part of the lease contract. So if we move on now to a slightly different fact pattern. So here, a customer and a freight carrier form a contract where the supplier will provide the customer, in this case, with the use of an equivalent of 10 rail cars of a particular type over 5 years. The supplier has a large pool of similar cars of that type that can be used to fulfill the requirements of the contract. The type of good and supplier quantity to be transported are specified in the contract. The contract also requires the supplier to provide an engine and a driver when requested. Engines are again held at supplier premises, and the supplier can attach other cars to the engine as well. The engines are not specified in the contract, and the supplier can choose any one of several engines to fulfill the contract. So the same options here. Option A, both the rail cars and engines are subject to lease. B, both the rail cars and engines are not subject to lease. C, only the rail cars are part of the lease. Or D, only the engines are part of the lease. Okay, so we'll close the poll there. Quite a few responses to this one again. And we'll see here that the majority of people have gone with the second option. Neither the rail cars nor the engines are under lease. And that's the correct answer. So in this example, the customer doesn't receive substantially all the economic benefits from the rail cars, and the customer doesn't direct the use of any asset. The supplier has the ability to substitute the cars and engines as they please throughout the period of use, and the supplier can benefit economically from doing so. There's no identified asset in this contract. What we're really looking at here is a contract whereby the supplier is only providing freight and capacity services to the customer as opposed to it being a lease. So let's move on now to look at the second step, which deals with the lease term. So the lease term is defined as the non-cancelable period of a lease, including the option to extend the lease if the lessee is reasonably certain that that option will be exercised, and any periods covered by an option to terminate the lease, again, if the lessee is reasonably certain not to exercise that option. And when we talk about lease terms, we frequently refer to two specific dates, the lease inception date and the lease commencement date. So it's important just to be able to understand the distinction between the two. So the lease inception date is the date on which the agreement is signed. No accounting actually takes place at that date. It's only when assessments are being made. Whereas the lease commencement date is the date on which the lessee gains control of the asset and the lease is actually recognised from an accounting perspective. One final point to note here is that in those scenarios whereby you have both the lessee and the lessor each having the right to terminate a lease without permission from the other party, at no more than an insignificant penalty, then in those circumstances, the lease can no longer be considered enforceable. So let's move on now to look at a few examples of assessing and evaluating lease terms. So in the first example, a lessee has an option to extend. The company here leases an office space for 5 years with an option to extend for a further 3. The lease includes significant leasehold improvements made by the lessee, which are expected to have a useful life of 10 years. Based on this fact pattern, do people think the lease term should be 5 years, 3 years, 8 years, or 10 years? We'll give everyone just a few minutes to respond. And if we close the poll there, so the vast majority of people have gone with the third option of 8 years. And the answer here is indeed 8 years. as this is because it's considered reasonably certain that the lessee will exercise their option to extend the lease for the further 3 years. And that's primarily because of the significant investment they've made by way of leasehold improvements, which they expect to use for up to 10 years. If we move on now to consider a slightly different fact pattern. So in this example, only the lessor has an option to cancel. A company enters into a 10-year lease for a warehouse, but the lessor has a break clause at the end of year 4. The lessee has again invested in custom racking systems that are not transferable and has a long-term distribution contract dependent on this location. So based on these facts, do the majority of people think the lease term should be 4 years, 10 years, no lease, or it depends? We'll give everyone a few minutes just to respond. So we will close the poll there. We probably have a slightly greater spread of answers here. So we've just over 50% have gone with 4 years, a few have gone with 10 years, and a few with it depends. So the answer here is 10 years. And this is because if only the lessor has the right to terminate the lease, then the non-cancelable period of the lease will include the period covered by the lessor's option to terminate. And I guess whenever we're looking at the assessment of lease terms, we're really looking at it through the lens of a lessee and what they are expected to do. So imagine we were to tweak the fact pattern slightly here, such that the lessee has the option to cancel with a break clause at the end of year 4. In that scenario, the lease term would again be 10 years. This is because, based on the fact pattern presented, it would be considered reasonably certain that the lessee wouldn't exercise their right to break early at the end of year 4 because of the significant investment they've made and the dependence they have on the contract that they're servicing from this location. So let's take a look now at consideration. So on this slide, we have Company A and Company B who form a lease contract for the use of machinery. The lease term is summarised as annual fixed payments of €40,000 per annum payable at the end of each of 5 years. The discount rate implicit in the lease is 10%, and there are additional variable payments of €5,000 per annum based on usage. So in this example, the lease liability would be calculated using only the fixed annual payments of €40,000 discounted back at 10% over the 5 years. The additional variable payments here are usage-based payments, and hence they would be excluded from the initial measurement of the lease liability and instead would be expensed to the profit and loss account as they're incurred. And this is because they can't be predicted or they can't be estimated reliably. So if we look at a slightly different fact pattern as presented on this screen, if the lease payments were to be linked to CPI, as is the case here, the initial lease liability would be calculated using the CPI rate at the start of the lease. Any subsequent changes then to CPI would adjust the lease liability prospectively, ensuring that the liability reflects the updated cash flows, but without the need for any retrospective change. So in this example, at the start of the lease, CPI is 1%. So the initial lease liability would be calculated using that 1% rate. If CPI were later to increase to 3%, for example, the lease payments would increase accordingly, but adjustment would be made prospectively the liability would be remeasured at the new rate at the date from which it becomes effective and applied on a go-forward basis. This obviously contrasts with the previous example whereby we saw some usage-based payments which are excluded from the calculation of the lease liability and simply expensed as incurred. On this screen, we've tried to show for presentation purposes how the lease liability would be measured. So in this example, when we recognise the right of use asset and the lease liability for any contract, we'll always start first with the calculation of the present value of the lease payments at the interest rate implicit in the lease. In this example, we do have an interest rate implicit in the lease of 10%, but if the interest rate implicit in the lease were not available, you can use either an incremental borrowing rate as an alternative, which is consistent with IFRS 16, or you can use an obtainable borrowing rate, which is a new concept introduced under FRS 102. And the obtainable borrowing rate is defined as the rate that a lessee would have to pay to borrow an amount equal to the total undiscounted lease payments over the lease term. So I guess it's maybe considered slightly easier to determine an obtainable borrowing rate than it might be an incremental borrowing rate. So in this example, you'll see that the lease liability is calculated by discounting back the annual payments, the fixed payments of €40,000 per annum at the 10% interest rate implicit in the lease. In this example, the lease liability and right of use asset are brought on balance sheet by debiting the ROU asset, crediting a lease liability for the same amount in this example, but just to bear in mind that sometimes you can see differences between the two. For example, if a lessee were to capitalise certain direct costs associated with the lease, that would result in a variance between your right of use asset and your lease liability at the initial date of application. So if we now have a look at what the subsequent measurement would look like. So as we mentioned earlier, the right of use asset is depreciated over the shorter of the lease term or the useful life of the underlying asset. So in this example, we have a simple depreciation calculation where the depreciation is being calculated on a straight line basis over the 5-year lease term. On the liability side, we can see an unwinding of interest being recorded as an expense to profit and loss, with a decrease in the principal amount of the lease liability outstanding as cash payments are being made. So this slide attempts to summarise the accounting impact for lessees introduced by the new requirements of FRS 102. On the left, you'll see how leases will now be reflected in the primary statement. So from a balance sheet perspective, lessees will recognise a right of use asset and a lease liability, which will then be broken down into its current and long-term portions, depending on when the repayments fall due. From an income statement perspective, your operating lease expense, as previously reported, is now replaced with a depreciation charge on your right of use asset and an interest expense on the lease liability. As we mentioned earlier, this results in a front loading of your lease expense because of the interest component being higher in the earlier years. And this is demonstrated on the bar chart to the far right, where you can see that despite the fact that your cash repayments will remain constant over the life of your lease, your P&L expense will be higher in the early years, and this will have the impact of potentially reducing metrics such as EPS. The bar chart in the middle of the screen is really just trying to depict the fact that the ROU asset and the lease liability will decline over the lease term, but at varying rates. So I guess as a result of the changes, lessees will appear more asset rich from a balance sheet perspective, but they'll also appear to be more heavily indebted. And not to forget the impact that this change in accounting treatment will have on the calculation of EBITDA and other financial ratios. So EBITDA will receive an immediate boost because the operating lease expense is now replaced with depreciation and interest, both of which will fall below the EBITDA line. Gearing will also increase as a result of these changes, whilst other financial metrics such as interest cover, asset turnover, and current ratios are likely to decrease. And not to forget then the optional exemptions available for short-term leases and leases of low-value assets. In those scenarios, the lessees will continue to expense to profit and loss rather than to bring assets and liabilities on balance sheet. So I guess overall, these changes will significantly alter and affect how leases are presented and interpreted in the financial statements. They'll have real-time implications beyond the P&L and balance sheet. You'll have to have a think about your financial ratios, other key performance indicators and metrics that might be of interest to a wider stakeholder group. And finally, just to wrap up, we have included on this screen a brief summary of some, but not all, of the differences between IFRS 16 and Section 20 of FRS 102. Some of these points we've already talked about, and I guess at a high level, FRS 102 might provide a little bit more flexibility in terms of, for example, the introduction of the obtainable borrowing rate as an option to determine your discount rate, or accounting policies in certain areas that might not be the case under full IFRS. And just to recap in summary, in terms of transition, lessees will be required to apply the modified retrospective approach to recognise their lease liability and right of use asset at the date of application. So that basically means that you have no restatement of comparatives, and to the extent you've a disconnect between your lease liability and your ROU asset at the date of initial application, you would take that difference through your opening retained earnings. And just one final point to call out in terms of those entities that are currently part of a larger IFRS group. So to the extent you're maybe already part of a wider IFRS group, you maybe report internally for consolidation purposes under IFRS. For those entities in that scenario, you have the option to use your IFRS 16 figures already calculated for internal group reporting purposes and to bring those on balance sheet at the date of initial application. So hopefully that provides a quick insight into the new requirements in respect of leases. And with that, I'll hand over to Saad, who will talk to some of the other amendments. Thank you.
Yep, thank you, Kelly and Rob, for those wonderful insights on revenue and lease accounting. So the focus, obviously, in this session has mainly been on the two key areas so far, being changes in revenue recognition and lease accounting. However, there are a number of other changes that shouldn't be overlooked and should be covered in your impact assessments. While we will not be able to cover all the changes in detail, we will cover some of the highlighted key changes that we believe will impact most of the industries. So let's begin by looking at financial instruments. Entities that are already applying IAS 39 for financial instruments can continue to do so. However, if entities are applying IFRS 9 or Section 11 and 12 of FRS 102, it is no longer allowed to revert back to IAS 39. It is to be noted, however, that this requirement is restricted in cases where it is necessary for consistency with group financial statements. For example, think of a company that does not apply IAS 39 and is now acquired by a group that does. Then that company may revert to using the IAS 39 for consistency with the group financial statements. In relation to disclosures, the measurement basis of financial instruments and policies is now only required to the extent that it is a material accounting policy. Shifting our focus to supplier finance arrangements. From accounting periods beginning 1st January 2025, Section 7 of FRS 102 requires additional disclosure for supplier finance arrangements. Entities must now disclose key terms, impact on the statement of financial position and cash flows, and a few other specific details. Early assessment in this area is advised to ensure compliance and to avoid year-end surprises. Next, return to fair value measurements. So the new section aligns with principles of IFRS 13. It clarifies fair value concepts, including market types and valuation approaches. A key change for liabilities is the shift from a settlement concept to a transfer concept, which now considers the entity's own credit risk. Entities performing recurring valuations should reassess their methods to ensure continued compliance. Moving on to going concern disclosures, entities must now explicitly state that financial statements are prepared on a going concern basis. Management must also disclose all significant judgments made in assessing going concern based on all the available information and future assessments. These changes enhance transparency and accountability in financial reporting. The key change to keep in mind, however, is that if entities prepare their financial statements on a going concern basis, they are now required to state that the financial statements have indeed been prepared on a going concern basis. So let's now consider business combinations. Section 19 of FRS 102 has been updated with an appendix to include guidance on the identification of an acquirer in a business combination, more likely like the principles of IFRS 3. There's also more guidance on the accounting for contingent consideration and remuneration for future services. This will not only impact goodwill calculations, but it will impact profit and loss as well. And the guidance in summary is that we will have to distinguish these two items according to the nature of the arrangement. Turning to share-based payments, Section 2 of FRS 102 includes enhanced guidance on accounting for vesting conditions, fair value determination, and share-based payments with cash alternatives. If the entity transfers cash for settlement of an equity-settled share-based payment, the new standard now requires cash payments to be recognized as a deduction from equity. However, if such amount exceeds the fair value at settlement date of shares that would have been otherwise issued, such excess is recognized as an expense. Also, vesting conditions other than market vesting conditions will no longer affect the fair value of cash-settled share-based payments. However, all market vesting conditions and non-vesting conditions will be considered when estimating the fair value of cash-settled share-based payments at each reporting date, as well as the settlement date. Finally, let's touch a bit upon uncertain tax treatments. So the new guidance is now more aligned with IFRIC 23 and assumes that tax authorities are now aware of all relevant information when assessing tax treatments. Where uncertainty exists, entities must now apply a clear measurement basis, such as expected value, a weighted average method, or a most likely amount. So the standard does not specifically prescribe which method you should apply, so entities should ensure that their approach is consistent and supportable. So I would like to highlight, though, this list is not exhaustive, and these are just a few highlighted areas of the key changes, and entities will have to see whether this change may affect you while making your impact assessments. So that does wrap up the updates from my side. I'll now hand over to Eamon to see if there are any questions the audience may have. Over to you, Eamon.
Thank you, Saad, Rob, and Kelly for bringing us through that. As you can see from the content here, there's a real step change now in applying FRS 102. It's become a lot more complex than it was before. And also, you can see as well for IFRS preparers here on the call today that IFRS and FRS 102 have now just got a lot closer, actually to the point where some of our clients are considering whether they should move from FRS 102 to IFRS now, rather than implementing these changes to FRS 102, given that the gap is narrower. There are still differences between IFRS and 102 and simplifications, like I said, but they have got a lot narrower. We've lots of Q&A in, conscious of people's time. We just have about 5 minutes. Just to note, there are some very specific questions and questions that would take a long time to unpick and answer here today. So if anyone raised those questions, we will reach out to you individually to answer them. Maybe just to cover off on one or two more general type questions. Kelly, in relation to leases, can you just expand a little bit on transition, please? And specifically, the question is around what do I need to do with my 2025 comparatives when I apply the new leasing requirements in my 2026 financial statements?
Sure, Eamon. So the new requirements require the use of the modified retrospective approach. So under that approach, there's no need to restate your 2025 comparatives. You'll calculate your lease liability and right of use asset at the date of initial application. And to the extent you maybe have an imbalance because of directly attributable costs or something along those lines, you'll take an opening adjustment through your retained earnings at the date of initial application for those. Obviously, anyone who's in the realms of wanting to apply the exemptions, they would take those into account at the date of initial application to avoid having to bring an asset and liability on balance sheet. And those that are part of a larger IFRS group further then have the option to use their IFRS 16 numbers as already determined and to bring those on as their opening balances at 1 January 26.
Okay, thanks, Kelly. And that's interesting because you could have comparative financial statements that actually are not comparable in terms of your 2026 financials. Then will have lease asset, lease liability on them, P&L one way, excuse me, and then your 2025 comparatives won't. They'll be under the old method. Just very quickly, Kelly, on lease exemptions, could you just tell us a little bit more? Some people are asking around how can they get the exemptions. I'm sure lots of people are interested in that, to try and avoid this lease asset and lease liability. So just very quickly, what are those criteria to get the exemption from putting them on the balance sheet?
Sure. So there are two key exemptions. One is for short-term leases. So I guess to the extent you have a lease that's expiring within 12 months of the initial date of application, then you would have the option to continue expensing that through your profit and loss. The other exemption then is for those leases where the underlying asset is of low value. This one's probably a little bit more judgmental. So for an underlying asset to be considered low value, the lessee has to be able to benefit from the use of that asset on its own. The asset can't be highly dependent or interrelated on other assets. And whilst the standard itself doesn't give a monetary threshold or a guideline amount under which an asset would be considered low value, there are a list of assets included in the revised standard which wouldn't be expected to meet that low value criteria. So that's helpful.
Thanks, Kelly. And Rob, maybe just one question on revenue. There's a lot more technical, the new requirements, but practically, what level of changes do we expect on the ground for people is one question that's come in.
Yeah, thanks, Eamon. And look, to be honest, I think it will depend on facts and circumstances. And I was actually speaking to a client recently where the new changes under FRS 102 are going to require them to reevaluate their principal versus agent considerations. One of the indicators under the old standard for determining whether or not you were a principal was that you had credit risk. This client was kind of borderline. It was nearly kind of 50-50 previously. So credit risk standard, so that could have very significant changes and impacts for them. What outside of that specific example, I'd expect anyone with complex contract arrangements in terms of providing bundled goods or services will probably find the implementation of these new changes tougher. Reason being is that when we're implementing IFRS 15 previously, I remember a lot of my software clients struggling to implement these changes in practice. So really very much a case of facts.
Yeah, thanks, Rob. And actually, the fact you mentioned IFRS 15, one of the benefits here of these changes is that because it's essentially brought IFRS 15 and 16 from IFRS into FRS 102, we have a lot of experience, and as do our IFRS clients, with what it took to implement IFRS 15 and 16. So it's really not underestimating that. Just going to wrap up. See, we've just hit the end here with a brilliant question, which is, what should I do next? Question mark. And look, I guess that depends on where you are in the process of the transition. But I'd say it's really important here to be well planned, to be well organized, to put a plan in place for how you're going to implement these changes, to make sure that it runs smoothly, that it runs efficiently. I'd say do not underestimate what it would take to implement the changes, and obviously contact your KPMG contact or any of us here on the call, and we'd be happy to bring you through it. Just in terms of wrapping up, the slides for today will circulate to everyone who was on the session. A recording will be available on the website. And finally, I'd just like to thank Rob, Kelly and Saad for presenting today, putting all the material together. And also finally to you, all of our clients and friends, thank you very much for taking the time to join us here today. We really hope that you found this a very helpful session, and we'll look forward to being in touch with you in future to talk about FRS 102. And with that, enjoy the rest of your day. Thank you.